Chapter 3 covers bonds and tries to explain the bond market. We'll get into more detail in the bond market in a future chapter, so this just kind of starts the basics of it. But basically, bonds are a legal contract between the issuer, who is the person who's going to pay the money back, and the person who's buying those bonds. And they're normally issued by a corporation, a government, or a state or local government. And how bonds work, they pay a coupon rate. Could be called a stated rate too, but this textbook's calling it a coupon rate. So they pay interest every year over the life of the bond, and that stated rate of interest stays the same throughout the time frame. So if it's for 10 years of a bond, that's how much interest you'll get interest every year at that exact same amount for those 10 years. And the reason it's called a coupon rate is back, years ago, before all the advancements in computers, the bonds were printed hard copy, and then there were little coupons on the bottom that you would, detach and take to the bank to get paid your interest. So now it's all done electronically, but those terms have kind of stayed with us. And the face value of the bond is the amount that the corporation owes. Bonds are normally issued in $1,000 increments. So that's how much they owe at the end of the term of the bond, whether it's, again, 10 years or 5 years or however long those are. The question becomes, okay, what would a person pay for those bonds? So initially, if those bonds are being issued by the corporation and the market rates are exactly what they're paying, so say the going rate in the bond market is 5% and those bonds are paying 5%, you literally would probably pay $1,000 for them because that's the true market rate. When they're then later sold, because bonds can go for 10 years or maybe even longer, maybe even 20 years. So there's what they call a secondary market. So that's when I'm the bondholder, and then I later decide I want to sell those bonds. So then I sell them in the secondary market. I find another buyer who'd be interested in purchasing them. But then at this point, the new purchaser is probably not going to be willing to pay $1,000 because market rates change. They go up, they go down. So that bond is probably no longer worth $1,000. And then that's what, then the textbook gets into the price of the bonds. How do we calculate that? And basically what we do is we really go back to our time value of money keys, and we would put it in to say, okay, well, my future value of the bond is $1,000. My N, or my time of that bond, is how long is left on those bonds. The payment is going to be the interest that we get every year, or that coupon rate times the $1,000. The IY, it would be the current market rate. So like if you looked around at other bonds, what are other bonds paying? Has the market rate gone up from 5%, or is it up to 6%, or did it go down to 4%? And then that would be your IY, and you'd compute the present value. So basically what that computation does for you, though, is it's taking into consideration, this is how much you're going to get interest. It's a fixed amount. This is how much you're going to get at the end, $1,000. So then it says, okay, factoring in what the current market rate is, what would be a fair price to pay? And then that's kind of how we calculate it. So then if those bonds, if you calculated that fair price for those bonds and it's less than $1,000, it's less than their face value, then those bonds are selling at a discount. Then if it goes the other direction, and that would be, again, though, the market interest rates would have to be above the coupon rate. So other bonds in the market are paying more. So then if other bonds are paying more, I'm going to pay less for these bonds that have a lower rate of interest. Then the reverse would be true. If other bonds in the market are paying a higher rate of interest, if the bonds that you have are paying a higher rate of interest than the other bonds in the market, then your bonds would sell at a premium. They would sell for more than $1,000. So it kind of goes back to look at the market. If your bonds pay less than market, the price is going to go down. If your bonds pay more than market, the price is going to go up. So they'll be at a discount if they go down, a premium if they go up. So it's good to kind of understand just the basics of those bonds. Then the textbook gets into the supply and the demand, kind of the economics side of the bonds. The change in the quantity supplied, the textbook describes it as this: the change in the supply is a change in the price and the quantity relationship from a seller's perspective, whereas a change in the quantity supplied comes from a change in the price of the good or the service. So the change of supply occurs when the seller changes. So like if they all of a sudden say, okay, the seller of a bond is a corporation or government. So if something's happening in the market that they say, hey, we want to sell more and more bonds, that's going to increase the supply. And then there'll be more bonds out there for investors to choose. And that would kind of shift the whole supply curve. You know what I mean? All of a sudden the supply curve is going to shift to the right. If it's just a change in the quantity like that, but the supply curve stays the same, then the price is going to go up on those. The demand could go could go that way too, to say, okay, well, maybe consumers or investors, people like you and I, want to invest in the bond fund, and we're wanting more and more bonds, but then the supply is not there. Again, that's going to push that demand out, which is going to kind of change where those prices are. So those supplies and demands can also impact the price and kind of impact that market. And then it gives you some reasons that there could be changes in the supplies. So if we look through the table, and you've got it in your PowerPoint too, if businesses are expected to have an improved market, they're going to issue more bonds because that's how they finance their growth. If they feel like, ooh, we're going down into like an economic downturn, they're not going to issue out bonds because that's how they finance their growth, and they're not going to grow. If inflation is expected, then they also want to issue out bonds because that interest rate is fixed. So then they'll get all that money today, and they'll pay a fixed rate of interest over the life of those bonds, which would then be, in a sense, saving them money, because inflation is going to make the value of the dollar will be higher later. And they'll be still paying that same fixed amount. If inflation is expected to go down, then bonds would go down as well. If there's more government deficits to cover, then obviously governments issue bonds, and that's how they pay, especially our federal government. So then the bonds would go up. If there was investment tax credits, then that means they're giving businesses tax credits to expand and to increase and to do more. Then again, they're going to want to issue more bonds to finance that growth. So then the bonds go up. If there's fewer tax credits, then the bonds go down. So you can kind of see there's just outside things that can influence those. And then you can read about that in the textbook. Then the demand for bonds comes from us, from consumers, people who are willing to invest in the bond market. So as we have more disposable income that we want to invest, then our demand for bonds is going to go up. We want to invest. We want to take it beyond just our savings accounts. If we see that, hey, we're getting a good return on those bonds, again, our demand for bonds will go up, and we would want to invest there. Bonds are normally a little less risky than investing in stock market. So if we felt like the risk was better on the bond market, again, that's going to increase our demand for those. And then it talks about, but there's always that risk. There's always a default risk that the company will not be able to repay you when it comes due. So that is the risk of a bond. But it's a little less riskier than a stock because you're a creditor as a bondholder. And then it talks about liquidity, the ability to convert it into cash, or the ability to sell that bond if you needed to. That is interest to investors. And then information cost. If you're going to be an educated investor, you're going to want to take the time to kind of research those bonds. So again, there's a nice little summary table. As our wealth increases, we have a demand for bond. It's going to increase. If the returns on bonds are going up, our demand for bonds is going to go up. If they're riskier, if bonds are becoming riskier, then our demand goes down. If they're less risky, then our demand goes up. If they're easily liquidated or sold, our demand goes up. If they're not so easy to sell, then our demand's going to go down. If there's more information costs, then our demand goes down if we got to do more research on them. And then, the vice versa of all of those would be true. And then it gets into there's always, economics, there's always that equilibrium point where supply meets demand, and that kind of helps to pick your price. So if there's a shortage, if there's more demand than supply, the price goes up. If there's more supply than demand, the price is going to go down. Then it gets into, the textbook gets into the supply and demand for loanable funds. So the supply of loanable funds come from households. If we're putting money into savings accounts, the banks can then pull those money and loan them out to people who need them. Companies do the same thing. If they have a surplus of income, they put it into their savings account, and the banks again can pull that out. Same with governments. And now kind of in our new world economy, other countries can too. So other countries can invest in our bond funds. They can invest in our money market funds. They can make deposits into our banks. So all those things can impact this supply. Then it talks about, okay, the demand. Well, who wants those loanable funds? It's really all the same people. So consumers want loans to buy houses, to buy cars. Businesses want loans to get bigger, to buy more assets. Governments also are, building new schools, new roads, new city halls, stuff like that. So they want money as well. And then even again, internationally, we can loan to other countries, and we do loan to other countries. So all of those people can be users of that money too. So there's definitely a lot of things that can impact that, because you're talking to kind of everybody's involved in the supply and everybody's involved in the demand, kind of all across the world. Then the last section gets into business cycles and confidences within those business cycles. So it talks about that as business confidence is increased, they spend more. So if you're feeling comfortable as a business owner that, hey, I'm looking great, then 3 years looks like it's going to be solid and we're going to be booming, you're more than likely to spend more, to hire people quicker, give raises. All those things impact the economy. Then we have less unemployment. People are making more money. They have more disposable income. They're saving more. Then again, there becomes more loanable funds. So that all kind of grows the economy. But then, the flip side of that can happen too, because, like it says, what goes up must come down. So there's always a point where then we're at that economic high and we're going to start to go down. And then all of those changes kind of go back through, and all of those things impact our loans and our interest rates. And again, the bond market, because the bond market is the way that corporations borrow money and governments borrow money. So they all kind of go hand in hand. Okay, so that is it for chapter 3.